Welcome to Finance Frontier, the podcast where we explore the most pivotal shifts in the financial world. I'm Max, and today, we're coming to you from the historic New York Stock Exchange, a place that has been at the epicenter of global finance for over 2 centuries. The NYSE isn't just a building on Wall Street, it's a symbol of resilience, innovation, and strategic decision-making. From the chaotic trading floors of the 1920s to the digital revolution that transformed trading in the 21st century, the NYSE has been a witness and a participant in some of the most significant events in financial history.
That's right, Max. The New York Stock Exchange has seen it all. The Great Depression, the dot-com bubble, the financial crisis of 2008, and more recently, the unprecedented market volatility brought on by the global pandemic. Each of these events has tested the limits of financial systems, yet the NYSE has always been a beacon of stability, helping investors navigate through uncertainty. It's the perfect setting for today's episode, titled S0732 Finance Frontier: Strategic Financial Moves in a Shifting Economy, where we'll be discussing how businesses and investors are making strategic financial moves in a shifting economy.
In today's episode, we'll dive deep into the current market trends, exploring how rising interest rates, global supply chain challenges, and shifting consumer behaviors are reshaping the investment landscape. We'll also examine the strategies that top corporations are employing to stay ahead in these uncertain times, including the increasing focus on digital transformation, supply chain resilience, and sustainability. Additionally, we'll bring you expert insights on the economic outlook for 2024, where we'll discuss the potential impacts of inflation, monetary policy, and global trade tensions. These insights are crucial for anyone looking to navigate the complex and often unpredictable financial environment we find ourselves in today.
And it's not just the big players we're focusing on today. We'll also discuss the role of emerging technologies like artificial intelligence and blockchain in finance, and how they're driving both opportunities and challenges for businesses and investors alike. By the end of this episode, you'll have a clear understanding of how these trends and strategies could impact your own financial decisions in the year ahead. We'll also touch on how these innovations are shaping the future of industries beyond finance, providing a comprehensive look at where the global economy might be headed.
As always, our goal is to provide you with actionable insights that you can use to navigate these complex times. Whether you're an investor looking to refine your strategy, a business leader steering your company through uncertain waters, or simply someone interested in the future of finance, this episode is packed with valuable takeaways. And remember, it's not just about understanding these trends, it's about applying them to your own financial strategies to ensure that you're not just surviving but thriving in the years to come.
Before we dive in, a quick reminder to subscribe to Finance Frontier on your favorite podcast platform. By subscribing, you'll ensure that you never miss an episode filled with insights that can help you stay ahead in the ever-changing financial world. And if you find today's discussion valuable, please consider leaving a review and sharing the episode with your network. Your engagement helps us continue to deliver the content that matters most to you.
So stay with us as we explore these critical topics from the heart of global finance, right here at the New York Stock Exchange. It's not just about understanding the trends, it's about leveraging them to make informed and strategic decisions. Let's get started.
Let's start with an overview of the current market trends. Lately, we've seen significant movements in various sectors, with tech stocks in particular experiencing notable fluctuations. This volatility has been driven by a combination of rising interest rates, shifts in consumer behavior, and global supply chain disruptions. These forces are not just influencing stock prices, they're reshaping the way companies operate and how investors approach the market.
One of the key trends we're observing is the increased investor interest in value stocks. As inflation concerns continue to loom large, many investors are shifting away from high-growth tech stocks and are instead focusing on sectors like energy, finance, and consumer staples, which are seen as more resilient in times of economic uncertainty. This shift is significant because it reflects a broader change in investor sentiment, where the focus is moving from growth at any cost to sustainable, long-term value.
Additionally, the energy sector has been particularly active, with oil prices fluctuating due to geopolitical tensions and changes in global demand. Investors are closely watching these developments, as they could have far-reaching implications for both the stock market and the broader economy. The importance of energy as a foundational economic driver cannot be overstated, and its performance often serves as a barometer for the health of the global economy.
Another important trend is the state of the broader market, which is showing signs of significant overvaluation. The Buffett Indicator is currently at 193.9%, signaling a highly overvalued market. This level of overvaluation suggests that expected returns are close to 0.1%, a red flag for long-term investors. It's a reminder that while markets can stay irrational longer than expected, such levels of overvaluation typically precede periods of correction.
The Shiller P/E ratio, also known as the CAPE ratio, has soared to 35.8, further highlighting the deepening overvaluation. With expected returns around 2.4%, this is another indicator that the market may be overextended. Investors should be cautious, especially with gains concentrated in a few large-cap stocks while most others underperform. This concentration risk is something investors need to be aware of, as it can lead to sudden and sharp market corrections.
On a more technical level, the Nasdaq has shown strong bullish momentum, currently above all major EMAs, including the 5, 10, 20, 50, 100, and 200-day moving averages. However, the low trading volume raises concerns about the sustainability of this rally. It's a signal that, despite the technical strength, the underlying support for this movement might be weak. In such scenarios, it's crucial for investors to pay attention to not just the price action but the volume and participation driving it.
The VIX, or Volatility Index, has dropped to 14.81, falling below its 200 EMA, which signals reduced market volatility and eases immediate concerns. This decrease in volatility, combined with stable credit spreads, suggests that investor confidence remains steady, at least for now. However, it's important to remember that low volatility periods can sometimes precede sharp market movements, so staying vigilant is key.
To sum up, the current market trends reflect a dynamic and rapidly changing environment. While the Nasdaq's performance may tempt some investors to go long, it's essential to approach with caution due to low volume and significant overvaluation signals. As we move forward, it will be crucial for investors to stay informed and agile, adapting their strategies to the evolving conditions. Keeping an eye on these indicators and adjusting portfolios accordingly can help mitigate risks and capitalize on emerging opportunities. Corporations are facing tough decisions about where to invest their capital in 2024. With economic uncertainties on the rise, strategic investments are more critical than ever. Companies are reassessing their portfolios and making calculated moves to ensure long-term growth and stability. This isn't just about survival, it's about positioning themselves to thrive in a post-pandemic world where the rules of the game are constantly changing.
One of the key strategies we're seeing is a focus on capital allocation. Companies are carefully deciding where to deploy their resources, whether that means reinvesting in their core business, pursuing mergers and acquisitions, or returning capital to shareholders through dividends and buybacks. Each of these choices reflects a broader strategy for navigating the economic landscape. For many businesses, this means striking a delicate balance between maintaining financial flexibility and investing in future growth.
Mergers and acquisitions, in particular, have been a significant focus. Companies are using M&A as a tool to strengthen their market position, acquire new technologies, or expand into new markets. For instance, company name, recently acquired, Target Company, a move that's expected to enhance their capabilities in sector. This is just one example of how companies are leveraging strategic acquisitions to stay competitive. These deals are often driven by the need to achieve scale, access new customer bases, or acquire innovative technologies that can provide a competitive edge.
Beyond M&A, there's also a strong emphasis on innovation. Companies are investing heavily in research and development, recognizing that staying ahead in today's market requires not only financial prudence but also technological advancement. We're seeing substantial investments in areas like AI, automation, and sustainability, which are expected to drive growth in the coming years. These investments are not just about keeping up with the competition, they're about setting the pace for the industry and shaping the future of the market.
Additionally, Companies are increasingly focused on building resilience into their strategies. This includes investing in digital transformation to streamline operations and enhance customer engagement, as well as reinforcing supply chains to mitigate the risks exposed during the recent global disruptions. Sustainability initiatives are also front and center as businesses recognize the long-term value of reducing their environmental impact and meeting regulatory demands. In many cases, these efforts are also aligned with broader ESG goals, which are becoming a critical component of corporate strategy.
As we look ahead, it's clear that the companies that are most likely to succeed will be those that can balance short-term pressures with long-term vision. By making smart, strategic investments now, they're positioning themselves to navigate the uncertainties of 2024 and emerge stronger on the other side. This approach requires not only financial discipline, but also a deep understanding of the evolving market dynamics and the ability to adapt quickly to changing conditions. In times of economic uncertainty, strategic moves can make or break a company. Businesses are increasingly focused on making decisions that will not only help them weather the current storm, but also position them for future growth. Let's take a look at some of the key strategic moves that major corporations are making right now. These moves are not just reactive, they're proactive steps that are setting the stage for long-term success in an unpredictable environment.
One significant trend we're seeing is the shift towards digital transformation. Companies across various industries are accelerating their adoption of digital technologies, not just to improve efficiency but to create new revenue streams. For instance, Company Name has recently launched a new digital platform aimed at capturing market share in the fast-growing e-commerce sector. This move is a clear example of how companies are using technology to adapt to changing consumer behaviors and market conditions. Digital transformation is no longer optional, it's a necessity for survival and growth in today's market.
Another critical strategic move is the focus on supply chain resilience. The disruptions over the past few years have highlighted the vulnerabilities in global supply chains, and companies are now taking steps to mitigate these risks. This includes diversifying suppliers, investing in local manufacturing, and adopting advanced logistics technologies to enhance supply chain visibility and agility. By building more resilient supply chains, companies can reduce their exposure to future disruptions and ensure they can continue to meet customer demands even in challenging circumstances.
Additionally, we're seeing companies prioritize sustainability in their strategic planning. With increasing pressure from consumers, regulators, and investors, sustainability has become a key differentiator. Companies are setting ambitious goals to reduce their carbon footprint, improve energy efficiency, and develop sustainable products. These initiatives not only help the environment but also enhance brand reputation and customer loyalty. In many industries, being seen as a leader in sustainability can provide a significant competitive advantage.
It's clear that the companies making these strategic moves are positioning themselves to not just survive but thrive in the years to come. By embracing digital transformation, bolstering supply chain resilience, and committing to sustainability, they're building a foundation for long-term success in a rapidly changing world. These strategies are not just about managing current challenges, they're about seizing opportunities and setting the stage for future growth.
And it's not just large corporations making these moves. Small and medium-sized enterprises, SMEs, are also adopting similar strategies to stay competitive. In many cases, these smaller companies can be more agile and quicker to implement changes, giving them an edge in rapidly evolving markets. By staying flexible and innovative, SMEs can carve out niches in the market and compete with larger players. Now, let's turn to the experts to get a sense of what the economic outlook might be for 2024 and beyond. With so many variables in play, from inflation and interest rates to global trade tensions, predicting the future is more challenging than ever. However, leading economists and financial analysts have provided valuable insights into what we might expect in the coming year. Their perspectives help us understand potential economic directions and provide guidance on navigating these uncertain times.
One of the key discussions among economists revolves around inflation and monetary policy. As central banks continue their efforts to combat rising inflation, we are likely to see a continued tightening of monetary policy. This could lead to higher interest rates, which may slow economic growth, particularly in sectors like real estate and consumer goods, where borrowing costs play a significant role. The challenge for policymakers will be finding the right balance between controlling inflation and supporting economic recovery, a delicate task that will impact markets globally.
Another important point of focus is the potential impact of ongoing global trade tensions. With continued disputes between major economies, there's a risk that trade restrictions could further disrupt supply chains and increase costs for businesses. This scenario could lead to higher consumer prices and potentially slow down economic growth. The uncertainty around trade policies makes long-term business planning difficult, which could result in more cautious investment strategies from corporations.
Despite these challenges, some analysts believe that technological advancements and innovation could help offset some of the economic headwinds. There is optimism, particularly in sectors like technology, healthcare, and renewable energy, where ongoing investments and innovations are expected to drive growth. These industries may continue to expand, even in a challenging economic environment, offering opportunities for investors who are able to identify and capitalize on these trends.
Another area of concern that experts continue to monitor is the inverted yield curve, which has historically been a predictor of economic recessions. While the yield curve remains inverted, signaling potential recession risks, other factors like strong consumer demand and stable employment figures are providing a more balanced outlook. These mixed signals suggest that while caution is necessary, there are still opportunities for those who can navigate this complex landscape effectively. It underscores the importance of remaining flexible and adaptive in your investment strategies.
Overall, the expert consensus seems to be one of cautious optimism. While significant challenges lie ahead, there are also areas of opportunity, particularly for those who are prepared to adapt to changing conditions. The key takeaway for 2024 is that flexibility and informed decision-making will be crucial for navigating the economic landscape successfully. In today's volatile market environment, effective risk management is more important than ever. Investors and businesses alike are facing a range of uncertainties, from fluctuating interest rates to unpredictable market movements. To navigate these challenges, it's crucial to have strategies in place that can help mitigate risks and protect assets. The key is not just to avoid losses, but to position yourself to take advantage of opportunities that may arise in these volatile times.
One of the most fundamental risk management strategies is diversification. By spreading investments across different asset classes, such as stocks, bonds, real estate, and commodities, investors can reduce their exposure to any single market downturn. Diversification doesn't eliminate risk, but it can help smooth out the ride by balancing losses in one area with gains in another. This approach is particularly valuable in times of uncertainty, as it provides a buffer against the unpredictable movements of any one asset class.
Another key strategy is hedging. Hedging involves taking positions that offset potential losses in your primary investments. For example, an investor who owns a portfolio of stocks might buy put options as insurance against a market decline. While hedging comes at a cost, it can be an effective way to protect against significant losses, especially in times of high volatility. By strategically using hedging instruments, investors can protect their portfolios from extreme market swings, ensuring that they are not overly exposed to sudden downturns.
For businesses, risk management often involves more than just financial strategies. Operational risk management is also critical, particularly in areas like supply chain management, cybersecurity, and regulatory compliance. Companies that proactively address these risks are better positioned to avoid disruptions and maintain stability even in turbulent times. For instance, businesses that have invested in robust cybersecurity measures are less likely to experience costly breaches, while those that have diversified their supply chains can more easily weather disruptions caused by geopolitical events or natural disasters.
It's also important to keep an eye on market overvaluation indicators, such as the Buffett Indicator and the Shiller P ratio. With both indicators showing significant overvaluation, this could be a warning sign for potential market corrections. Investors might consider adjusting their portfolios to include more defensive positions or increasing their cash reserves to take advantage of buying opportunities that may arise in the event of a downturn. Being proactive in this regard can help investors not only protect their wealth, but also position themselves to capitalize on opportunities when valuations become more attractive.
Finally, it's crucial to have a contingency plan in place. Whether you're an investor or a business leader, being prepared for worst-case scenarios can make a big difference. This might include maintaining a cash reserve, securing lines of credit, or having alternative suppliers lined up in case of supply chain disruptions. Contingency planning allows businesses and investors to react quickly to unforeseen events, minimizing potential losses and ensuring that they can continue operations or investments with minimal disruption.
The bottom line is that risk management isn't just about avoiding losses. It's about being prepared to navigate whatever the market throws your way. By taking a proactive approach and employing a range of strategies, you can better protect your assets and position yourself for long-term success. In times of volatility, those who have a well-thought-out risk management plan are often better equipped to emerge stronger on the other side.
Technology is playing an increasingly central role in the world of finance. From artificial intelligence and blockchain to fintech innovations, new technologies are transforming how we manage money, invest, and even think about financial markets. These advancements are not only driving efficiency but also creating new opportunities and challenges for investors and businesses alike. The pace of technological change in finance is unprecedented, and those who can harness these tools effectively will be well positioned to lead in the future.
One of the most significant technological developments in finance is the rise of artificial intelligence. AI is being used to analyze vast amounts of data, identify patterns, and make predictions with a level of accuracy that was previously impossible. For example, AI-driven algorithms are now commonplace in trading, where they can execute trades at lightning speed, optimizing for the best possible outcomes. Beyond trading, AI is also being used in areas like credit scoring, fraud detection, and personalized financial planning, revolutionizing how financial services are delivered.
Blockchain technology is another game changer. While it's often associated with cryptocurrencies like Bitcoin, the potential applications of blockchain go far beyond digital currencies. Blockchain offers a secure, transparent way to record transactions, which has enormous implications for everything from supply chain management to voting systems. In finance, blockchain is being explored as a way to streamline processes, reduce fraud, and improve the efficiency of cross-border payments. The decentralized nature of blockchain also opens up new possibilities for financial inclusion, particularly in regions where traditional banking infrastructure is lacking.
Fintech companies are at the forefront of many of these innovations, challenging traditional financial institutions and bringing new products and services to market. From mobile banking apps that allow users to manage their finances on the go, to peer-to-peer lending platforms that bypass traditional banks, fintech is democratizing finance and making it more accessible to a broader audience. This disruption is forcing traditional financial institutions to innovate or risk being left behind. Many are responding by partnering with or acquiring fintech startups to integrate these new technologies into their own operations.
However, with these advancements come new challenges. As technology evolves, so too does the regulatory landscape. Governments and regulatory bodies are grappling with how to oversee these new technologies, particularly when it comes to issues like data privacy and security. For businesses and investors, staying compliant while taking advantage of new technologies is a balancing act that requires careful planning and foresight. The challenge lies in navigating a rapidly changing environment where regulations may lag behind technological advancements.
Looking ahead, it's clear that technology will continue to drive change in the financial sector. Those who can leverage these advancements to their advantage will be well positioned to thrive in the future. Whether it's through AI-driven investment strategies, blockchain-based transactions, or the latest fintech innovations, the future of finance is undoubtedly digital. The key for businesses and investors will be to stay informed about these developments and be ready to adapt to new technologies as they emerge.
It's also important to recognize that the adoption of these technologies is not just about staying competitive, it's about redefining what's possible in finance. As AI, blockchain, and fintech continue to evolve, they will open up new frontiers in financial services, creating opportunities for innovation that we can't even fully envision today. The organizations that are able to anticipate these trends and position themselves at the forefront of technological change will be the ones that lead the industry into the next era.
Before we wrap up, let's take a moment to address a couple of questions we received from our listeners. These questions are always insightful and often reflect the concerns and curiosities that many of our audience members share. Our first question comes from Sarah in Chicago, who asks, with all the talk about market volatility, what are some of the safest investment options right now? Max, what are your thoughts?
Thanks for the question, Sarah. In times of market volatility, many investors look to safer, more stable options to protect their portfolios. Traditionally, assets like U.S. Treasury bonds, high-quality corporate bonds, and even cash equivalents like money market funds are considered safe havens. These investments tend to be less volatile and can provide a steady return, even in uncertain times. Additionally, gold is often seen as a safe haven asset because it tends to hold its value or even appreciate during periods of economic instability. Of course, the best option depends on your individual risk tolerance and financial goals, but these are generally good places to start if you're looking to reduce risk.
It's also worth noting that diversification within these safe haven assets can further reduce risk. For example, within the bond market, you might consider a mix of government and high-quality corporate bonds, with varying maturities to spread out interest rate risk. Another strategy could be investing in dividend-paying stocks of well-established companies, which can provide a steady income stream while also offering some protection against market downturns. Diversifying across different types of safe assets can help create a more resilient portfolio that can weather a variety of market conditions.
Our next question comes from James in San Francisco. He's curious about how inflation might affect long-term investments, especially in a high-interest rate environment. That's a great question, James. Inflation can erode the purchasing power of your money, which means that over time, the real value of your investments could decrease if they don't keep pace with inflation. In a high-interest rate environment, the cost of borrowing increases, which can impact corporate profits and, subsequently, stock prices. However, certain assets, like real estate or commodities, tend to perform well during inflationary periods because they often appreciate in value along with rising prices.
Indeed, inflation is a key consideration for long-term investors. One strategy to hedge against inflation is to invest in Treasury inflation-protected securities, TIPS, which are government bonds that adjust their principal value in line with inflation. Another approach is to focus on stocks of companies with strong pricing power, those that can pass higher costs onto consumers without significantly affecting demand. These companies are often found in sectors like consumer staples and utilities, where products and services are essential, and consumers are less likely to cut back even as prices rise.
Additionally, investing in real assets like real estate or infrastructure can provide a hedge against inflation. These assets often generate income that increases with inflation, such as rental income from properties or toll revenues from infrastructure projects. By including these types of investments in your portfolio, you can help protect your purchasing power over the long term. It's all about finding the right balance and ensuring that your investments are well positioned to weather different economic conditions.
To sum up, while inflation presents challenges, it also offers opportunities for those who are prepared. By considering how inflation impacts different asset classes and adjusting your investment strategy accordingly, you can better protect your wealth and even capitalize on inflationary trends. Staying informed and proactive is key to navigating these complex economic dynamics.
That brings us to the end of today's episode. We've covered a lot of ground, from the latest market trends and corporate strategies to expert insights on the economic outlook and the role of risk management in these volatile times. These discussions are not just theoretical, they have real implications for how you manage your investments and business decisions in the year ahead. Understanding these dynamics can help you make more informed choices and better navigate the complexities of today's financial landscape.
These are critical topics for anyone looking to navigate the complexities of the current economic landscape. Whether you're an investor, a business leader, or simply someone interested in the future of finance, The insights we've shared today should help you make more informed decisions. Remember, the financial world is constantly evolving, and staying ahead of these changes is key to maintaining a competitive edge. It's not just about keeping up with trends, it's about understanding the underlying factors driving those trends and positioning yourself to take advantage of emerging opportunities.
One of the main takeaways from today's episode is the importance of adaptability. The markets and the economy are in a state of flux, and those who are willing to adjust their strategies in response to changing conditions will be best positioned to succeed. Whether it's through diversifying your portfolio, embracing new technologies, or making strategic investments in your business, flexibility will be your greatest asset. The ability to pivot quickly and effectively in response to new information can make the difference between success and failure in today's fast-paced financial environment.
Another key point is the value of staying informed. The economic landscape can shift rapidly, and having access to accurate, up-to-date information is crucial for making sound decisions. That's why we're here, to provide you with the insights and analysis you need to navigate these uncertain times. But it's also important to continue your own research, stay engaged with market developments, and consult with financial professionals who can help tailor strategies to your specific needs and goals.
If you found this episode valuable, don't forget to subscribe to Finance Frontier on your favorite podcast platform. We'd also love to hear your feedback, so please leave a review and share this episode with your network. Your support helps us continue to bring you the latest insights in finance and economics. Sharing the podcast with others who might benefit from these discussions is a great way to help build a community of informed, proactive investors and business leaders.
And be sure to tune in next week, where we'll be diving into the latest developments in fintech and how digital currencies are shaping the future of finance. You won't want to miss it. We'll also be answering more of your questions, so keep them coming. We're here to help you stay informed and ahead of the curve. Your questions often guide our discussions, so don't hesitate to reach out and let us know what's on your mind.
Thank you for joining us today. Until next time, stay informed, stay adaptable, and stay ahead. And remember, in the world of finance, knowledge isn't just power, it's your greatest tool for success.
Before we sign off, we'd like to remind our listeners that the content of this podcast is for informational purposes only and does not constitute financial advice. The views and opinions expressed in this episode are those of the speakers and do not necessarily reflect the views of our affiliates or sponsors.
Please consult with a qualified financial advisor before making any investment decisions. Additionally, this episode referenced market data and news from sources including Google News and Investing.com. These sources provide valuable insights, but it's important to consider them in the context of your own financial situation and goals.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under a Creative Commons Attribution 4.0 license. The Finance Frontier podcast name and content are copyrighted materials and may not be used without permission. We take great care in selecting the music and content for each episode to ensure it complements the information we provide and enhances your listening experience.
We also want to acknowledge the evolving nature of the financial markets. The information shared in this episode is based on current trends and data, which can change rapidly. Always stay informed and make decisions based on the most up-to-date information available.
Thank you for listening, and we look forward to bringing you more valuable content in future episodes. Stay tuned, stay informed, and continue to explore the frontiers of finance with us. All content in this episode is copyright 2024 Finance Frontier. Unauthorized use, reproduction, or distribution is prohibited without express written permission.